Ladies and gentlemen, hello and welcome. This is the Cautious Trader here. Tonight we want to do things a little bit differently. First off, as always, I'm going to just give you a few updates on USDCAD, Bitcoin, US Oil. But later in the episode, and if you're interested, you should stick around. We're going to talk about the state of the market in general. And as you know, it's been heading lower, and we want to see what's going to happen, why that is, and if things are going this way, what you should do. Okay, so to start off things, as I said last night, once the floor breaks, we're going to head lower. Of course, we did. We are testing 125 now. Probably going to go to 124.5 before really seeing a bounce back. And that's with USDCAD. As far as US oil is concerned, still on the way up, just as we predicted. Of course, this is no surprise, given that the economies are opening back up, and as US oil or oil in general goes up, so does the Canadian dollar, and that's what we're seeing right now. And as far as Bitcoin is concerned, on the daily chart, we see a reverse of the downtrend, not necessarily to go back up and retest the highs, but probably to just retest 51,434, this level right here, the 0.236 Fibonacci level, before rolling over and heading back down. Again, there is a long way to 40,000, and that's where I think we're really going to see any sort of resistance if Bitcoin was to turn around and head back up. It has to test this area before making new highs. Okay, so those were the things I wanted to discuss. Apart from that, let's go and have a look at the ARK investment portfolios, just to get a feel for where the market is headed. Of course, the ARK innovation stocks are some of the most impressive ETFs that we've seen in a long time. Of course, they all headed by the queen of investing, Cathie Woods, and so far this year they've all like 100% or more than 100% up, right? And not this year, but like in the past year. So of course it doesn't hurt to have a look at that. And I want to begin by RKK. We go to RKQ and the other stuff as well, right? All right, let's open these up and have a look. It is always important for you who are investing to realize what you're investing in, because if you don't know what you're investing in, then you won't have any clue of what's going to happen when the market starts rolling over, right? If you know what you're buying and you have confidence in it, then that's good. Okay, but if you don't know what you're buying, then the moment the market starts rolling over, what ends up happening is you're gonna be feeling uncertain. Uncertainty breeds fearfulness, and you're gonna take action out of fear, right? And when you take action out of fear, the opposite of what you intend to happen will happen. And essentially, the objective is to make money. So if you're acting out of fear and all of a sudden you see things going down, heading lower, and you have the uncertainty because you didn't do your homework and you didn't look into what you were buying, and you're too concentrated in one asset area or one asset class, what will happen is that you will act and take action based on fear and end up losing money, right? So to begin this, let's read the description of RKK. Okay, RKK, it's been heading up beautifully over the past year, and if we have a look, it used to be at $33 per share and right now it's at $138. Okay, so that's like, if I'm not mistaken, more than quadrupled, right? Actually less than that. So almost like it has increased by about 300%, right? From the bottom here to all the way to where we're at right now. If we were taking the bottom back in March of last year, right? So of course, over the last month, it's been heading lower, and that was no surprise because the way that the Fed was pumping the markets, it was eventually gonna head back lower and have a correction. And I don't think we're really seeing a crash here, but I do think that the markets are gonna cool off. They're a little bit risk off. That's the word they use when investors try to consolidate and take profit and just slowly become less risky. And as federal like treasury yields go up, people take their money out of more risky investments and put it in less risky investments, because the less risky investments are going higher up in their yields. But as an investor who's focused on long-term growth, what should you be doing? Okay, and that's what we're really in the business of. We're a business of long-term investments, long-term holdings, right? So let's read this. It says the fund description and the objectives of RKK. Okay, what is it? It says ARK defines disruptive innovation as the introduction of a technology-enabled new product or service that potentially changes the way the world works. Companies within RKK include those that rely on or benefit from the development of new products or services, technological improvements, and advancements in scientific research relating to the areas of DNA technologies or genomic revolution, industrial innovation in energy, automation and manufacturing, the increased use of shared technology in infrastructure services, and technologies that make financial services more efficient. Okay, so the four areas they focus on are genomics, industrial innovations, next-gen internet, and fintech innovations. RKK is an actively managed ETF that seeks long-term growth of capital by investing under normal circumstances, primarily at least 65% of its assets in domestic and foreign equity securities of companies that are relevant to the fund's investment theme of disruptive innovation. So the key word here is long-term growth. If you're going into ARK investments, ARK ETFs, and you want to make a quick bucks out of it, the moment it starts rolling over, you're going to panic and you're going to sell out of it. But the whole point with ARK ETFs is they're betting on the future and how disruptive the future companies will be. These companies today that are making innovations, they're going to have big impacts. And if you trust the management of ARK ETFs and of course the picks that the queen of investing herself does, then you should buy and hold. And if it's going lower, then perfect. It's giving you a discount. It's putting things on sale. Now, I'm not saying that you should go out there and start buying a whole lot of it again. Think of it as if you're going into a store, right? And you're walking around and you see a 5% sales, right? That doesn't really get you that excited. So what do? Maybe you pick up what you really needed, right? And you're like, perfect, I really needed this, so let me buy it. 5% off, I'll take, right? Let's say the next week you come in, it's 10% off, right? You're still gonna buy the essentials, the things you were looking for, right? But you might be thinking, well, this thing that I really didn't need but kind of wanted, it's 10% off. Maybe I'll take a little bit of it, right? And then if markets continue to go lower and head lower, and you get 20% down or 30% down or 40% down, even better, right? Things are just on sale. Buy them, take them in, and enjoy them. Okay, what you have to realize, and a lot of people who haven't been exposed to the cryptocurrency market don't understand this. The cryptocurrency market regularly has quote unquote sales of 50% or of 80%. Some of you may not remember this, or some of you are coming into the crypto situation too early. But before we had this massive run up, and I want to show you the chart for it. Before we had this massive run up, Bitcoin was not doing so well, right? It peaked at 20,000, and then people started selling, and people quote unquote bought the dip, right? And how much was the dip? Let's have a look. From the top to quote unquote the dip where people started buying, it was 40% down. And some people were like, oh my God, 40% on sale? Great, let me buy it. They bought in, and then it dropped again, another 10%, and it dropped again. And by the end, it was all the way down 65%. 65%. And when I personally started buying crypto in 2018, I bought it around the 6,000 level and the 7,000 level. And guess what happened? It dropped another 50%, right? So that was the point that really I couldn't take it anymore, right? I personally got out of crypto. I sold the Bitcoins I had. And of course, I'm immensely regretting it now, but it taught me a lesson. And what was that? It was that know what you're buying and why you're buying it. Obviously, it took me another year or two when I started working in the financial services industry to realize how inefficient the fiat currency is and how many problems it has and how much better it could be if implementation of cryptocurrency, specifically Bitcoin, became more mainstream. And that's when I realized that there is inherent value here to Bitcoin. And I regretted selling my Bitcoins even more, right? So had I understood that before going in, then when I saw another 50% drop, I would be like, that's a nice sale. Let's go in even more, right? Of course, had anyone bought Bitcoin at the 3,000 level, then they would have 20x their money. And that's not even on margin. If you have a 10% margin, you would have made 200 times your money back, right? So if you're going and investing, by all means, invest in risky stuff. That's okay. There is no problem with that. Just understand what you're investing in. Because if you don't, then when things start rolling down, that's when you're going to act out of fear, right? For example, the ARK ETF, let's just have a look at what they have. And by the way, these are amazing returns. 36% year over year, that's insane. That means every 2 years you would double your money. That's how crazy this ETF is, right? And it doesn't have to be like that every year, but over a long-term investing duration, even something as quote unquote little as 15%, that's huge. That's like every 5 years you would be doubling your money. Think about that. Regardless, the companies that RKK holds are Tesla, Roku, Square, Spotify, things like that, right? All major players, right? And if you believe in these companies and you believe in the investment philosophy of ARK ETFs, then if you see this going down, don't worry about it. Just nibble at it a little bit and think of it as the sales, basically the Christmas sales, right? Just before Christmas, you see things going on sale. Maybe in October and November, things start going down. You have the Black Friday, things are still going down, but maybe they're not as low as they should be, or maybe they're not hitting their bottomest point in their price. So you hold on, you take what you need, and you wait for what you want. And once there's a big sale on what you want, then you just grab more of it, right? Let's quickly read RKQ. RKQ says companies with ARK Autonomous Technology and Robotics ETF, RKQ, are focused on and are expected to substantially benefit from development of new products or services, technological improvements, and advancements in scientific research related to, among other things, energy, automation and manufacturing, materials, and transportation. These companies may develop or produce or enable autonomous transportation, robotics and automation, 3D printing, energy storage, space exploration. RKQ is actively managed. Of course, that's the biggest benefit of ARK ETFs. It seeks long-term growth of capital by investing under normal circumstances primarily in domestic and foreign equity securities of autonomous technology and robotic companies that are relevant to the fund's investment theme of disruptive innovation. Again, don't forget, what you're seeing here, and this is 25% year over year. These are insane returns, right? What you're seeing here is something that will keep growing for the next 10 to 20, maybe 30 years. And if you're investing for that duration of time, then perfect. Keep buying. Set a schedule, daily cost average into these ETFs, little at a time, okay? And I usually, when I do investment, and again, these are none of what I say is financial advice. You already know that. But what you have to do is have a set schedule, maybe every week, maybe every 2 weeks when you get a paycheck. Just buy. Keep buying. And specific amounts. Eventually, you're going to end up without even realizing it. And if this is happening in the background, so your mind is not focused on it, without even realizing it, you're going to have a massive portfolio that not only is very nicely diverse, but has grown immensely, right? Of course, everyone's investment strategy is different. If you're retiring soon, then obviously you must be investing in less risky assets, especially things and companies that are highly volatile like Tesla. You should steer away from them. But if you're investing for the next 10, 20, 30 years, there's no problem with going maybe 70% in on more risky, more volatile companies. At the end of the day, know what your goals are. Write down your goals. Write down what you want to invest in. Write down what companies you want to support, right? If you're going out there and you're buying a Tesla, for instance, and you love the car and you love the company, invest in it. Invest in it. Just support them. It's like your favorite influencer. Support your favorite influencers, right? They're also influencing our lives. But if companies are problematic, or the companies are doing shady stuff and being weaselly, like you just look at what Boeing did with their jets that fell out of the sky. You can read more into that, of course, but that's a company I wouldn't want to invest in, just because their business tactics are questionable, right? Or let's say defense manufacturers. That's another one I don't like investing in. They pay you the dividends of war. So these are some things you should really consider when you're investing. And without getting bogged down too much into the details, I'll just quickly go over RKW. These are focused on and are expected to benefit from shifting the base of technology infrastructure to the cloud, enabling mobile and new local services, such as companies that rely on or benefit from the increased use of shared technology infrastructure and services, internet-based products and services, new payment methods, big data, the Internet of Things, and social distribution and media. These companies may develop, produce, or enable cloud computing, cybersecurity, e-commerce, big data, etc. You see these. Of course, you should be looking at them if you're buying them. RKG is Genomic Revolution ETF that specifically looks at the genomic stuff. Companies that they have, of course, right here. Have a look at them. And RKF, these are the fintech stuff. Also really cool companies here as well. So if you believe in these companies, if you believe in this investment philosophy, then keep going at it and you won't be disappointed. The only thing I tell you to do is do your research, do your due diligence, and ensure that as you're investing, you know what you're investing in, and when things get choppy, you're confident that your philosophy and strategy will pay off. And also be quite diverse, right? Diversity is always a great thing, and especially great in investing. With that said, I want to end this episode. If you have any thoughts, comments, leave them to me. This episode was actually inspired by one of my good friends who is investing heavily in ARK portfolios, and he wanted to get my take on it. So I say my thanks to him. I don't know if he wants his name mentioned or not, so I'll keep it anonymous. Apart from that, thank you very much for lending me your ears, and I'll be back with you tomorrow night or maybe next week. Bye for now.